Imagine trying to steer a cargo ship through a violent storm with a broken compass. You can't see the waves coming, and you don't know your exact position. That is exactly what it is like running a modern business without real-time financial data. Midnight sessions for month-end closes don't signal productivity. They signal a system collapse. Every hour an accounting team spends past 10 p.m. trying to catch up increases the risk of the very financial errors that destroy cash flow. This chart shows the consequences of that collapse. 82% of businesses fail specifically because of poor cash flow management. It is the single largest threat to corporate survival. When leaders rely on monthly reports, they are looking at cash balances and expenses that are up to 30 days old. They are forced to make critical survival decisions based entirely on history rather than current reality. On the streets of Yangon and across Myanmar's digital storefronts, commerce moves continuously. Sales happen 24 hours a day, 7 days a week. But that high volume is fractured across a highly localized ecosystem. Customers send money through KBZPay, transfer via WavePay, or scan unified QR codes. The revenue arrives instantly, but the transaction data remains scattered. To handle this fragmentation, scaling businesses often hire teams of people to manually verify payment screenshots in Messenger or Telegram, and then copy and paste those transaction details into internal spreadsheets. Hiring a team specifically to copy-paste sales logs builds technical debt into the foundation of the business. This manual data tax consumes both capital and time that should be spent on scaling, creating an expensive bottleneck that grows more dangerous as sales volume increases. Eventually, human operators transpose numbers or miss duplicate entries. These errors don't just mess up the books, they delay fulfillment and destroy the customer trust that took years to build. Solving this requires moving past the concept of the month-end close. Modern financial systems use an application programming interface, or API, to connect the general ledger directly to regional payment gateways like Dinger or 2C2P. With this connection, raw transaction data flows securely into a central accounting system the exact second a customer's payment clears. There is no manual transfer of information. This diagram illustrates the continuous close model. This shows a comparison where transactions are matched daily in the background, preventing 30 days of raw data from piling up into an error-prone month-end spike. Unifying these incoming data streams into one structured database is the mandatory first step. Until the data is centralized and flowing automatically, artificial intelligence cannot be effectively deployed. Once that foundation is built, we enter the era of Agentic AI. Unlike simple chatbots, an agentic system is designed to autonomously monitor workflows and execute complex, multi-step tasks without waiting for a human prompt. This animated diagram shows how an AI reconciliation agent handles unstructured data. When scanning a PDF invoice or payment screenshot, it uses optical character recognition to instantly extract key information like dates, payment terms, and exact amounts. The AI then aligns these records with official bank settlements, automatically handling cross-checking, multi-entity consolidations, and currency conversions. Human controllers are removed from the routine matching process. The AI only flags a transaction if it finds an exception, such as an unusual spend velocity or a payment that doesn't match an invoice, passing only those specific anomalies up for review. By delegating the manual assembly of data to a machine, the finance department flips from reactive bookkeeping to proactive oversight of the company's capital. The immediate return is a recovery of wasted time. Businesses that automate these processes reclaim up to 40% of their finance team's capacity, while cutting reporting errors by half. This dynamic graph shows a single data point generating best case, worst case, and expected outcomes simultaneously. If acquisition costs spike, the system flags the anomaly immediately. Instead of waiting weeks, leaders can instantly pause campaigns and reallocate budget. This is the true value of an automated financial engine. A business stops spending resources recording yesterday's transactions and starts using its capital to shape tomorrow's opportunities. This level of clarity ensures a startup is constantly prepared for scrutiny. Because the ledger is always current, founders can generate flawless, investor-grade financial reports and board materials on demand. During due diligence, presenting mathematically perfect, real-time data proves that a company has implemented strict financial controls. It signals a level of organizational maturity that builds immediate trust with investors. Adopting these systems provides the operational foundation required to scale without limits, ensuring the backend can process 10,000 orders as smoothly as 10. When automated tools can reduce accounting overhead by 30% and eliminate the human error bottleneck, manual bookkeeping becomes a terminal risk. Steering a business with outdated maps is no longer a necessity, it is a choice.